Hey everybody, Craig Stanley here again from Summit Group. So before we get started, let's all take a deep breath. All right, so I'm here to talk to you today about market volatility, especially in light of some of the craziness we've seen in the last couple weeks related to the coronavirus and oil prices, a lot of things coming together to create what is certainly one of the bigger downturns that we've seen. Certainly not the biggest by any stretch, but a big one, and one that we're all recognizing and feeling. So what I wanted to do was not talk about the details of what's causing it, because at the end of the day, it really doesn't matter. What we want to talk about is, and what I want to talk about is 4 things that I want you to be thinking about as we go through this, as it relates to your long-term investing and performance. So number one is that this volatility is normal. We see it all the time in varying degrees, of course. Even the average intra-year drop or a correction that we might see in any given year, the average over the last 40 years is almost 14% for the S&P 500. So certainly this correction it has been more, and of course we have to have that to have an average of 14%. We need numbers on both sides, and this just happens to be on the bad side this year, but it's not something that we haven't seen before. In fact, one similar year that we could compare this to is 1987, where on Black Monday, the S&P 500 in one day dropped over 20%. And for the year, the S&P from top to bottom in that year went down to 34% a decrease. Yet, at the end of that year, the S&P 500 was still up over 5% for a total return. So just because we have these big swings doesn't even mean that we're going to see the end year bad. But again, we don't know. That is the unpredictable part, and there's really no sense in guessing where it goes. We need to just remember the fundamentals. With that said, let's hit on the second thing I want you to keep in mind, and that is there's a big difference between losing value and losing money. And inevitably, whenever things like this happen, there's somebody that will say, I just lost a lot of money because the market went down. But the reality is they didn't. Their values went down on paper. If they got a statement today, they're going to see the values of what they own decreased. But they own the same stuff in the same quantity that they did yesterday. And so only if you sell those things while the value is down do you actually realize a loss and lose money. And for most of us that are saving for retirement, we're not selling anytime soon. We're selling when we get to our 60s. And so as long as we're not selling, then it's okay if our value changes. It changes every day, and as markets recover, as they always have in our history, then those values will return, and again, we never lost money because we didn't sell it. The third thing, kind of in tandem with that, is to have a strategy. It's important to have a strategy because at the end of the day, really one of the main goals is we don't want to have to sell anything at a loss, right? That's our plan. We don't know what markets are going to do. They're unpredictable. What can we do as a strategy to avoid selling anything at a loss? And so, of course, again, while we're further away from retirement, it doesn't really matter. We're not selling, we're holding, we're in the stock market for the long term to try to get growth, and the values are going to change, and so be it. But of course, as we get closer to retirement, we want to start building in defensive pieces. So we want to own things that are not stocks, being bonds and cash typically. And so as we build that part of our portfolio as we get older, which many of you may already be doing without even knowing it, because you could be using a target date fund or some other type of strategy within your retirement plan that does that for you. But if not, you should make sure that you are gradually getting more conservative. But assuming that that's been done and those fundamentals have been followed, then if I'm a year or even less from retirement and I'm concerned about this market downturn, well then what you need to do is look at your portfolio and identify how much you have outside of the market. Because if you start to bucket that out and segment it, then you can have a better perspective and understand that, okay, well, yeah, my values are down in total, but really where that's coming from is the 60 or 70% that I have in the stock market that I don't plan on selling anytime soon, because I have 30 or 40% sitting defensively that I could begin to pull from in a time like this and not sell it at a loss. Or if it was at a loss, it'd be very small, again, depending on what kind of conservative investments you have, but it's certainly not impacted the way the stock market holdings would. So once you can segment it out in your head and you see that perspective, then it's able to calm you down, because you know that you have maybe even several years worth of defensive investments to pull from in a time like this. And then when the markets recover, as they always have, you rebalance and you fill those buckets back up again. And then, when the next one happens, you follow the same kind of strategy. And then the last thing that I wanted to just throw at you was to try to find an opportunity in this, the half glass full kind of mentality, because despite a lot of the negative headlines and stresses that certainly the media will put on us as well, there are opportunities here, and maybe the opportunity is to just find a way to save more. Maybe now is a great time to increase my contribution 1%. I won't feel that probably in my cash flow, but if I can put a little bit more in now and maybe potentially buy things while they're on sale, all the better. Maybe I can front load some of my retirement contributions for the year and try to take advantage of this downturn. Maybe it's not about saving more, or maybe it's just about stepping back and revisiting your financial picture, revisiting your budget, your retirement budget. It's been a great run since our last bear market, 07, 08, 09 timeframe. We've all kind of gotten used to this, gradual up market, and maybe our spending habits have gotten a little bit, out of place. And so maybe this is the time to force us to just step back a second and revisit that budget, make sure that we're doing everything we need to do to keep our financial health, and make a change, whether it's financial or otherwise. So that's my hope, is that everybody can find something positive in this, to make ourselves better, to make our society better, to make our world better, so that as we come out of this, as I'm confident we will, and as we always have, that we'll all be better for it. So hope you find some value in this video today. If you have questions or concerns, feel free to reach out to us. We're always here if you need us. Take care. We'll talk to you guys soon.